So Ted, another company for us to look at, and a really interesting one today. So for all those in the UK, you will probably have heard of this company. I think it was around June last year. And in the US, you may or may not have heard of this business anywhere around the world, but let me give you an introduction. So it's a company called Gymshark, and it's become really famous, Ted, actually, because a number of celebrities, including the Kardashians, have been promoting this particular brand. So the founder has been very clever in how he has got the word out about the brand through social media. And Gymshark essentially do fitness wear. And they became famous in the UK last year because he got an investment group called, let's check, the General Atlantic, and I'll talk about them later on. But General Atlantic invested around £200 million, which valued this business at £1 billion, which officially made it a unicorn business, and it's one of the few in the UK. And the founder is very young, 20, I think it was 27 at the time. He's now 28. And I think it's worth looking at the finances for this company because it became such a massive news, all through the normal news outlets, through social media. It became a big success story. And for sportswear, no less. It's not technology or the usual suspects when it comes to becoming unicorn businesses. This is very much a textile business in fitness brands and nothing more than that. Which makes it very interesting. When I dug a bit further, they're doing some really interesting things. But I'd love for us to talk about the finances and see, what made it such a high valuation, and do the finances justify it?
Well, it's good to speak to you, Moeed. Thank you very much for once again inviting me on the call. So yeah, you know what I mean. I actually do quite a lot of exercise. I'm getting on in my years, but I do a lot of running, I row, kite surfing, skiing, etc., etc.
Oh.
I'm not really that familiar with the brand either, but I kind of feel it's not really aimed at me. It's very much the younger generation. It's the Instagram market. If you're going to go to the gym and work out and take pictures of you kind of ripping your biceps or doing whatever it is you're doing and posing, you kind of want to look good. And my understanding is that he just felt that there was nobody who really had the right brand out there or the right clothing, and therefore that's what he's tried to fill. And as you say, he's been very successful at it, and it's a really interesting route to market. So let me just share my screen now. So I'm just going to share. Here we go, and we're going to have a look at the numbers. So you should be able to see. Here we go. There we go. So Gymshark. So the first thing to realize about the numbers that we're going to look at, Moeed, is that these numbers. So it's a fairly simple setup for a company. It's not actually, they've set up a new company called, I think it's called Clyde, which is the holding company. So we're going to look at Gymshark, but you can go one up, but the holding company is a non-trading company. So the numbers in the holding company are pretty much the same as the financial statements. And I'll just come on to a couple of reasons why I think that there's this difference, this holding company. So as we know, the holding company, so the Gymshark, they make gym wear. So that's what they're talking about here, and the way that they have expanded. So let's just jump straight in and look at, and here's Mr. Ben Francis, I think his name is, who's obviously doing extremely well for himself. And congratulations to him. So no problems with the audit report. The auditors appear pretty happy with the numbers. So here we see the turnover. So this is we're looking at the income statement here to look at the trading account. The first thing to notice is that the gross margin of this company, that's the 117.5 million pounds worth of profit. Let me get my annotation chart out. So that's this number here expressed as a percentage of sales is about 67%.
Yeah.
So 67%, it's very, very high indeed. Yeah. Now, it is very, very high. And the reason it's high, I think, is because of their model. And what you've got to look at is this number here as well. So if you're Nike, for example, Nike, their distribution methodology is through shops basically. So you know, and the shops is kind of a cost of sale. Whereas here it's basically it's all the kind of the postage. So there's a lot of postage going on there. It should appear as part of the sales general and administrative, you know. So the cost of sales is only the cost of actually, you know, the product that they're selling, and the manufacture of that product. So it won't include the end distribution cost. But there is an argument that actually, for analysis purposes, we should probably putting that figure and including it up there. And we're going to then come into something which is a little bit closer to the industry average. And the industry average, as a rule of thumb, is basically you make about a 40 to 50% gross margin on your products. So remember that, Moeed, next time you go into the local sportswear shop and you see that it's a 30% discount, they're still making money. Okay, this is a reasonably high margin game that they work in. The other thing to notice is that, you know, this is a massive growth success. So they are growing rapidly. In fact, if you just take these two numbers here, so that's about a 76 million or 73 million increase on a base of 100 million in 2018. That's about a 70% increase. Okay, yes. That's massive. So 70%. So this is a real kind of success story. They're not managing to translate it into the bottom line. So the growth at the top line is not reflected in the growth at the bottom line. Okay, so part of the reason is that their gross profit margin is falling only slightly. It's down from 72 to 67%. And the operating costs have gone up significantly. So look at this increase in the admin expenses. Okay. Now, again, we don't know exactly why that is. So traditionally in our analysis, admin costs are what we call fixed costs, and suggest that as you grow your business, you don't need any more administration costs, because you only need one website, for example, you only need one head office, rent stays the same. What we may see here is that this is a big investment, though. This is obviously a rapidly growing company, and therefore they are heavily investing. They're expanding overseas. They're setting up overseas operations, et cetera, et cetera. So you may find that the administrative cost is a kind of an investment in the future, if that makes sense, like buying a new head office. Okay?
Well, they're making a big push.
So it's just worth bearing that in mind.
Yeah, I mean, they're making a big push into the USA. So they've just set up an office there. Can't remember where it is.
Absolutely. Yeah, but you don't need to spend 20 million setting up an office in the USA.
No.
I mean, it's you know, there's a big number going on there. So you know, it's you know, I mean, I think last time we spoke, we were talking about Kazoo, and I was kind of likening it to the space shuttle, where they're spending a lot of money and they're burning cash very, very quickly in order to accelerate and get momentum. These guys, they're equity funded. They've reinvested all of their profits. You know, he's done the perfect growth. He owns, you know, he's owned pretty much the whole company all the way through. He still owns 70% of it. You know, it's been a real success story. He's used the cash he's generated from the sale yesterday to invest in generating the sale tomorrow. So it's a really, really good story here. So I'm not going to detract from it. And there's obviously a big accelerating investment, but they're doing it and they can afford it, which is really, really good. So it's a nice, it's a strong P&L. It's a good company. They're making lots and lots of profits, and those profits are all being reinvested. You look down here, they're just not paying out any dividends at all. All of the profits they make are being reinvested back into the business. So that's the first thing we kind of see. Very profitable company. Net margin 9%, down from 14% in the previous year. The profit is growing. It's not growing massively. Lots of investment going on. Top line, very, very, you know, 70% growth. Very exciting. And actually, if we project that along, I think the estimate for sales, 260 million they're talking about for 2020. Obviously, they haven't filed their accounts yet. If they run at the same sort of margins, we should be expecting profits in the region of about 20 million. But again, that assumes that the admin costs are going up as well. So whether they can start to leverage their fixed costs will be a big key to really nailing that bottom line.
Right. And something to remember is that they don't market themselves as a premium brand. So the prices are not going to be as high as I think Nike and those. So they don't market themselves as premium, but they do market themselves as affordable, but great quality, great look, etc.
Absolutely, yeah,
That could,
and it's yeah, and so they've got a very big market out there. They're very much for the mass market, and lots of people buying into it, and that's an interesting that's an interesting approach. You know, you think about the brands in the marketplace. You know, if everybody else is wearing the same brand as me, does it lose its value? My personal experience, I've seen a lot of people wearing Canada Goose recently. I don't know, maybe it's just me here in Southwest London, but I'm kind of thinking everybody's got Canada Goose. It's kind of lost that exclusivity to me. I mean, I know it's a very different position of a brand, but and I'm not a brand expert, by the way, Moeed. I'm a financial expert, not a brand.
yeah. Well, I mean, I'm really interested to see what you have to say about, unless you have more to say about the P&L, but I'm really interested to see what you have to say about the balance sheet, because you're right in saying that their model is you know, they call themselves direct to consumer, and you know, they've really capitalized on, I think, a trend that's only going to grow, especially with the pandemic. I used to work with Beiersdorf, who are a German company that they're the makers of the brand Nivea. And 4 years ago, I think it was about 4 years ago, maybe 5 years ago, they were starting to kind of dip their toe into the direct to consumer model. They saw that this was an area that was going to grow. They can command more margin. They can have more direct relationship with the consumers rather than through the retail stores. And I think Gymshark have really capitalized it and showed that, you know what, this model can really work for you. So I'm interested to see what you have to say about the balance sheet and how that probably compares to companies like Nike, where a large part of what they do is still through the retail and in fact their own stores as well.
Absolutely. So, well, first of all, and I haven't looked at Nike's balance sheet, so you caught me on the hop as
Oh,
for a
sorry.
comparison there.
I
That's
meant
okay.
more about an industry thing,
But
yeah.
it's thinking about, so Nike probably, and I'm guessing here, Nike probably won't own their stores. They'll rent their stores, and
Yeah.
therefore the stores will appear a little bit like the distribution costs. Rather than having distribution
Oh, yeah,
costs,
good point.
which is Gymshark, they'll have store rental and the operating costs and all the salaries sitting in the P&L. So the stores won't sit in the balance sheet unless they physically own them. As I said,
Yeah.
it's not really what they do. But I've put up in front of you. So here is the balance sheet. We can start to see. So let's just highlight a few things. So these are the fixed assets of the business. So what they need to run the business. So this will be tables and chairs, plant machinery, equipment. Not a very big number there. It's 10 million pounds. You don't need a lot of money to run this. You know, you can rent your warehouses. They're going to have some computer systems and some distribution and IT and et cetera, et cetera. You can see that they've got some intangible assets, which is probably IT equipment sitting in there. This is a working capital business, and that's really looking at these numbers here. So we can see from these numbers, they've got 22 million quid's worth of stock, which is double what they had last year. Kind of makes sense. They're rapidly increasing the business. They want to hold the stock. The last thing they want to be doing is selling stuff which is out of stock. So they've got to be able to meet that stock fulfillment. They got a little bit of debtors in there, but I'll show you this in a bit more detail later. None of those are trade debtors. They don't run trade debtors. You pay and then we ship. So it's a really healthy approach from a cash flow point of view. They've got a decent amount of cash, 21 million last year, up to 30 million this year. So lots and lots of cash, very strong, very healthy. And the creditors, that's the people they have to pay soon, only 32 million. So if we compare these two numbers together, they've got lots of cash, lots of liquidity. You know, I'm not worried about this business falling flat on its face. I'm not worried about it. It's not going to be able to pay its bills. It's a really, really strong business.
Right.
People talk about there's no debt. It's not strictly true. There is a little bit of debt. It's tucked in this number here. It's about £4.5 million, but relatively speaking, compared with the size of the business, if we compare the debt to the equity, and this number here is the equity, we're really saying they don't have a substantial amount of debt. You know, there's nothing to write home about. So It's absolutely fine. The amount of debt they've got, and you can see there's a little bit of interest in the income statement. We actually almost missed it because it was such a small number compared with the rest. They can afford. This is a bit like Moeed, you earning £1 million a year and having £10,000 left on your mortgage. You're just not going to lose any sleep over it. So, you know, it's a really, really, really strong balance sheet. So I you know, hats off to and actually reading a little bit about Ben. You know, what he did do very early on, he knew he was onto something good. He brought in a CEO and a CFO. So he's had somebody running the numbers, you know, a really good, you know, obviously, you know, competent individual running the numbers, and then a CEO running the business that allows him to kind of focus on the slightly bigger picture and how he's taking it to market, product development, etc., etc.
Yeah.
And this, I think, is a really key strength of Ben, is that he recognizes his own limitations.
Absolutely.
I mean, I lost count of the number of times I've seen small businesses, they grow rapidly, they run out of cash. The managing director isn't, or the owner isn't prepared to let go. They're not prepared to kind of build a competent team around them with the systems and processes in place to allow them to actually control that business. So they don't like giving away control. So, you know, absolute hats off to him. You know, he's, you know, I mean, he is a textbook of how to grow, you know, a startup business from mum's attic up to, you know, what is, you know, clearly a very successful business.
Yeah. Really good story. Really good story.
Um, one of the things I'll mention here, Moeed, is that there's no cash flow statement. Okay, and the reason is there's no cash flow statement is they don't have to prepare one if you're a subsidiary company. You only have to prepare it at the head office, which is one of the reasons why it's quite interesting to go up one stage and look at the head at the group accounts. And they basically show that, you know, they're making a profit of about 15 million. They're generating cash of 11.7 million. Now, the cash is a little bit lower than profit, and that's a little bit nervous, but it's a very, very strong cash generating business. So I'm not going to lose a lot of sleep over that. But they don't have a business model that is generating more cash than profit, which lots of businesses like Coca-Cola and telcos and supermarkets do, for example.
Okay. And if it's just for the benefit of those watching, can you just translate what that probably means in terms of what they're doing in the business? So if the cash is slightly lower than the profit, does that mean that they are using some of that cash for the business and to grow it further, or is there more to it?
Yes, potentially. Well, let's I'm just going to pull in that cash flow statement so that we can, so we're actually talking about the right sort of numbers. So this is a useful, and actually, Moeed, you know, when I'm talking to my delegates, to my clients, this is probably the least understood part of the business. So this is the bit that people really struggle with. So what we've got on the screen right now is the cash flow, and the top line is the profit. So that's straight out of the profit and loss account. And this is their profit for that financial year, the bottom line, the net profit. And what they do is that they then make some adjustments for non-cash items. So an example here is depreciation. Depreciation is a cost to the business. But if your car depreciates in value, you don't lose cash from your bank account. It's an accounting adjustment. Okay, and that's what's going on here. They've got these sort of number of different adjustments that they're making. So, for example, they got some accrued expenses. So these accrued expenses I've incurred, but I haven't yet paid for. Therefore, they're reflected in the profit and loss account, but the cash hasn't walked out. The key, I think, is this bit here. This is the movement in working capital. So what we see here, for example, the top line is that they have taken a lot of the cash they're generating and invested it in more stock. Makes sense. They're a growing business. If you're going to double in sales, which they practically have, you're going to need a lot more stock. And so they need to be buying that stock. Okay, so making sure, and I'm sure they've got systems and you know, and the kind of the metrics which are measuring this in a manageable way. What's moving quickly, what isn't moving quickly, what's popular, what isn't popular. You know, the way he manages his various kind of, you know, lines and ranges, etc., etc. But you know, but that's a key thing. Often you see companies that they grow rapidly, they invest in, you know, lots more stock, and then they suddenly realize they haven't got enough money to pay their suppliers or to pay their staff, for example. So we're going from this number up the top down to this number here, and this is the cash generation. So they're generating a lot of cash, and you know, I'm not going to fault it. You know, 11.7 million pounds of cash generation is a fantastic number. So the next part of the cash flow, I'm just going to scroll down a little bit, is effectively what do they do with that cash? So this is basically a cash profit that they're generating. It's the cash equivalent of an accounting profit. This bit here is the investment. So they're a growing business. You'd expect them to be investing. They're mainly investing in tangible assets. So this will be, you know, if they're going to buy a production site, maybe they're buying warehouses rather than renting them, buying tables, chairs, computers, etc., etc. And a little bit of intangible assets. So this will be some maybe research and development, maybe IT investment. Again, we can have a look at see if there's any clues on that. And they have raised some debt. Okay, so there you can see that they've actually financed some of this through debt, and therefore what we're doing is we're taking this number here. Okay, we take this number here less the investment plus or minus the effect of borrowing, and that gives us the net cash increase, and that's effectively ends up with the cash going up by about £9 million in the year. So they've got lots of money, they've got even more money, they're generating cash, they're spending it wisely, you know, they're ticking every box on, you know, financially. We like this company, Moeed.
Yeah, I like it too. It's a great one.
Here we've got our staff costs. Now, you may remember last time I asked you to do a little calculation, so you might just do a calculation for me again. I have to admit, I haven't even prepared it myself, but so there's 261 staff, and they're paid £18 million in total. So what's the average pay per member of staff? You remember we were looking at Kazoo, and we reckoned that the average staff member was getting about £127,000, which sounded quite high to me, quite a generous payroll if I was an investor in that business. And don't forget, they're burning lots of cash, so they are very dependent on investors. These guys are not burning cash, they are not dependent on the investors.
No, it's much more modest than Kazoo. So their average is just over £69,000.
69,000, and that's going to be skewed. There's going to be some head office who are kind of, you know, paid, you know, a fairly substantial amount. Obviously, this includes the directors. You'll notice it includes the directors, but it won't include. So it'll be skewed by some big payments in there. Now, you may remember Alex Chesterman was earning only about 300,000. The director's remuneration. So old Ben is paying himself about 2 million quid. Yeah. You know what? He's worth it. I've got no problem with that. So the directors in total are taking out about £5.5 million. And I forget exactly how many directors there were. Let's just
maybe 4 or 5.
4 or 5. So that's so here we go. Here's the directors. Let's just zip through to the directors. Yeah, so 5 directors, 4 directors, one's gone, Chapel's gone. So you've got 4 directors in there. So that'll be basically his CEO and the CFO, who are probably splitting the last 2 between them. So 2 million to I would guess something like 2 million to Ben and $1 million to each to the other 3. And then if you take those out of the staff numbers, so if you take 18 and you deduct the 5, you're left with about 13 million. 13 million between 261 is, you're probably looking at about 50,000 or something.
49. 49, almost 50.
49. 50,000. So and that sounds pretty reasonable. So, you know, and if there are any employees here, I'm sure they'll say whether they feel that aggrieved as they're being underpaid to ship stuff around there. But, you know, this is the capitalist business, you know, and you know, so staff cost looks pretty reasonable to me. Very little interest. They're paying tax. Really like this. They're paying tax. You know, they're paying more tax than Starbucks have paid practically ever here in the UK. So there doesn't, you know, they're not damaging their reputation through offshore shell companies and sticking stuff in Luxembourg and all the rest of it. So, you know, big tick there. There's the intangible assets we talked about. So it's IT and software. So they're investing in their distribution platform, in their social media platforms, whatever they're using. They've got the so land and buildings. They're buying land and buildings, plant and machinery. I can't think that they need a lot of, I don't know that they're manufacturing. To what extent they're outsourcing their manufacturing, whether it's done in the UK, whether it's overseas, etc., etc. Kind of get impression it's got to be a bit overseas given the margins that they're working towards. They've got an investment in another company that's pretty irrelevant, I think, at the moment. So this kind of just says that they're investing in overseas subsidiaries. They're looking to grow. You mentioned USA. We've got Hong Kong sitting there, and then we come into the last section. The next section here, which is the working capital. Before I do that, any questions on the top half of the balance sheet, the investment capital?
No, I don't know. I think you've covered everything there pretty well. So no questions.
So let's look at the working capital, which is basically what you're looking at now. So there's the cash, and then you've got stocks, people who owe us money, and people we owe money to. So stock, as we mentioned, is pretty high. In fact, their stock turnover is quite high. I did a little calculation, and I reckon that they hold stock for just over 100 days. It's about 108 days on average. I don't have a sort of historical figure, but that's quite a long time to have money tied up. And there's a sort of, so I reckon that they're watching that quite closely. They're making sure that they're not holding stock for too long. It becomes obsolete, gets damaged, maybe. It costs you to store it, and also it goes out of fashion. I don't know they're kind of how often they're bringing in new fashions.
So that's an important point.
You'll notice
anyone watching this who's involved in logistical warehouse solutions or anything like that's an important number to look at. Anything that you can do to help reduce that, they're going to like it.
Absolutely.
And sales and marketing.
Yeah. And if they want to know how I calculated that number, they got to get in touch with me.
Yeah, of course.
You'll see trade debtors. I've highlighted the trade debtors. No trade debtors at all. Everything you pay, and then it gets shipped to you. Not sure what's in the other debtors. And then down here, trade creditors. So you can see these are the suppliers, the people they're buying the kit from. And I reckon, by my calculation, that their trade debtor days are, let me just work out. Here we go, 51 days. So I reckon that they're paying 51 days on average, which is, there's an EU director says, they're obviously a big company. They're very successful. They've got the negotiation clout. Traditionally we do 30 days here in the UK. They're pushing it up towards 60. That's just good cash management. So well done for that.
So expect that if you're trying to sell to them. Yeah.
This number here, accruals and deferred income. So these numbers here, this is deferred income. This is income I've received, but not yet actually earned. So what you may find here is that this is people who've paid for things and we haven't yet shipped it, or it's out of stock and we need to fulfill that order. So I don't think that's a major issue, but it's just one to kind of keep an eye on, because they're going to have to either give the money back or make sure they can fulfill those orders. It could be the sign of a very strong order book.
Yeah, significant number though, 14 million.
It is a significant number. It's not something you'd expect, but it may be, if you think about it, 176 million. So what's that, about 10%? It may be that it just, obviously if you buy something from them, you put your credit card details in and make the purchase, they've then got to go through the order fulfillment. And I don't know their lead time, but maybe it takes them 2 or 3 days to get it out into the post and off to you, for example. And when you take ownership, that's when they recognize. So again, you're back into, when do they recognize the sale? Is it when they ship it? Is it when you actually, when it's delivered to you, for example? It's probably when it's delivered, because that's when you take ownership.
Yeah.
So some interesting numbers in there. We just scroll down a little bit further. So there you can see the debt. So they got the bank loans, 4.7 million, still sitting on the and there's a little bit of a bank loan up here. So you add those two numbers together and you get the total bank loan. So there's a little bit of debt, but really, nothing to write home about, nothing to worry about too much. And really, that's pretty much it. I mean, it's as I said, that it's owned by the Clade Group. I don't know where they got the name Clade from, but the bank loan is fixed on is a fixed bank loan. They've got a little bit of finance leases. That's their cars perhaps are on a lease, or the photocopier. That's it. I mean, it's just there's not a lot else. I mean, they talk a little bit about financial instruments here. This is kind of, as they start to become international, they're going to need to kind of, manage their currency and currency fluctuations.
Yeah.
But a lot of them, they say, they're incurring costs and earning revenue in similar currencies. So they're kind of, they're not really doing a huge amount of hedging on that point. And then here are the shares. So they've got A and B shares. I'm not sure exactly. You may find that Ben owns the A shares and that he's given the B shares to somebody else. It may be voting rights. I don't know. And a bit of capital commitment. So they committed to spend 1.6 million pounds on equipment next year, for example. Obviously, that would have been this year, 2020, because these are 2019 numbers. And that's really it. I mean, there's nothing else that we can say about that. It's Mr. B. Francis. I take my hat off to him. He's achieved the dream, and he's done it really, really well. I think this will be a really interesting case study. And if there are any small business owners or entrepreneurs out there, this is a good example of how to run a business and not. He's not running before he can walk. He's done it very methodically. He's reinvested cash. He hasn't taken too much out of the business, and he's now sitting pretty on a fantastic business.
Yeah, and you know what? It's so interesting to look at the finances of a business, because I'm starting to really appreciate this, because most people's eyes glaze over when they see the finance and they just see numbers and complexity, and I can't understand that. But what I really love about this is you're now, if you look at, if you start to compare this to Kazoo that we looked at last time, right? You actually almost get a sense of the character of the company. Yes, the people behind it are the ones who are generating or creating that character of the business. But the finances really tell almost a personality. They give you an insight into the personality of the company, because Kazoo is just all about, they've got to pump in a lot of money to get that rocket ship to kind of leave the atmosphere. And, they're trying to push out as many cars as possible. They're spending a significant amount, something like just over 4 million on marketing, just marketing alone. They're trying to really get the word out there. Whereas the characteristics and the sense of that I get from Gymshark is slow and steady, right? Be not frugal, be smart with the money, slow and steady. As you said, we're not running before we can walk. We're doing this properly, but also we're not hesitant either. We are a growing business. We are pushing, but we're doing it in a steady and sustainable way that is good for the people that are the stakeholders, the customers, the suppliers, and especially the owners as well. That's the kind of sense that I get of the characteristic of this company versus Kazoo. Do you get that kind of sense as well?
Absolutely, 100%. I think that Alex Chesterman is somebody he's obviously a big personality, and he's really he's got a great sales pitch, and he sold the story to a bunch of investors, lit the touch paper, and now he's got to make it work. And I think that Ben, clearly doesn't need to convince anybody. I'm not sure that this is slow, but it's sensible. It's sensible growth. He hasn't overstretched himself. He hasn't said, "Oh, I've got a great thing here. Let's go billion-dollar global by by tea time tomorrow," for example. Yeah. So, and again, I think that part of that is that I think you've got to be a pretty driven individual to get there, and a pretty sassy and savvy individual. But he's built a team around him, and the team are really, really strong. And it's interesting you say, talking about the character. It started to get me think of a company I actually once worked for. If you ever go into Robert Dias and you see the little TVs advertising something that says "Take yours to the checkout now," it's all John Mills, and John Mills JML Limited is an amazing company. And I mean that's £1 million profit this year and £1 million loss the next year, and cash coming in and out and flying out. And that is that was a trading individual. He's a very big character, very enjoys risk, loves living on the edge. And people sort of say you're never quite sure whether the business is going to be there tomorrow, for example, and that's reflected in the accounts. So I think you're absolutely right. I mean, this is one of the nicest, cleanest set of accounts, the strongest company. It's a great business. However, we haven't talked about the elephant in the room, Moeed.
Yeah. Go
It's
on.
the valuation.
Yeah.
Okay, so my understanding is that the latest investment, that the 200 million, I think it was dollars where I read, but it may be pounds. I think it was $200 million made by what were they called? General Athletic. Okay, General Athletic, and this values the company at 1.45 billion.
Yeah.
Okay, that's my understanding. 1.45 billion. So just to put that into perspective, that's 1,223 times earnings.
Yeah. That's
We're in Tesla. Yeah, exactly. You're ahead of me there. We're in Tesla territory here.
Yeah.
Now, Tesla is not seeing 76% growth in sales. Okay, so let's be absolutely clear that it's a different kettle of fish. They're selling cars. They've got to make the car. All this guy's got to do is to stitch together another T-shirt. Okay, so expansion is much easier because he's not limited by production capacity. He can just find another factory in China and off he goes. So it's a volume game. Just that 1,223, that's the equivalent of investing your money in a bank account and getting 0.1%. It's a very low yield. It says to us it's a very high price. So this is a great car, but this is a bit like looking at a brand spanking new BMW, for example, and say this is just a great car, the new M5. It's a fantastic car, and then being told the price tag is 750,000. And you're like, yeah, it's good, but good. Is it that good? Yeah, I'm just, and I'm just thinking that, if I was this investor and you're paying that much money, there's a lot of good news in this. There's a lovely story, but it's all baked into the price. And this is the key thing, is that, there's two parts to, if you're making an investment, one of which is finding the gem, finding the jewel in the crown, but the other one is paying the right price. And if you pay too much for it, you may have a great company here and it'll go on to do great things, and it looks like it is, but I don't think you're ever going to get back your investment. You're never going to really realize the value that you bought, unless you can find a bigger mug than you. And believe me, there's a lot of bigger mugs than us out there. So sometimes, you don't have to realize it by your investment. You just need to be able to flip it and sell the story.
Yeah.
Which kind of brings on, sorry, you're going to ask.
No, I was just going to say, and maybe you were going to come onto it actually, which was around, General Atlantic is owned by Chuck Feeney. And for those in the US, they'll know who Chuck Feeney is. He's the kind of duty-free king, right? And he's worth billions. So there's something in there that's making me thinking, what do they see that maybe we don't or others don't? Because there is that push for international, because they're massive in the UK, slightly well known in the US, but they're really making a push there and in Asia, as you saw in the Hong Kong. But the other thing is, Ted, the only moat that I really see that they have is that brand equity. But
absolutely,
in an industry like this and the people they're going after, it's quite fickle in my view. So I'm wondering what other moats are there that we're not seeing, or maybe that's just it.
Well, and let's just define that term moat, Moeed, before we go any further. So, if people are thinking about a moat, there's no castle here. So we're talking about an economic moat that will allow them to defend the position they've got. So for Facebook, the economic moat is the network effect. I'm on Facebook because you're on Facebook, and you're on Facebook because I'm on Facebook. The same with Twitter and with LinkedIn, for example. For Coca-Cola, the economic moat is the brand. There's thousands of cola brands out there, but there's only one Coca-Cola, and they invest a lot of money. So you could argue that something like Canada Goose, for example, the economic moat is the brand. I have a friend of mine, he's got a brand, he's selling parkas for £1,400 a pop. And I'm just thinking, yeah, but unless you got the brand on the, nobody's going to be paying that, for example. So it's investing in the brand. And I agree with you, is the brand that strong? Now, I'm not part of the gym culture. I'm not part of these people who go along and stand in front of the mirror and kind of, pull the weights and preen it kind of, my muscles aren't quite what they used to be, and I don't think they're going to get any better. So he's promoted this on social media. You mentioned the Kardashians, for example. He's done very well in getting influencers with lots of Instagram followers, and I'm not even on Instagram, so hey, what do I know? But he's found the social media influences, he's tapped into that vein, and and it's growing. But I'm not convinced that it's a as quickly as it grows, it could all become yesterday's news. It could all become but that was Gymshark. We're actually on to something else. So you might think of this in a Boston Consulting Group kind of matrix. I don't know if you're familiar with that, where we talk about cash cows, where he's got a really good cash cow in Gymshark. Has he got anything else in the pipeline? What's the next thing that's coming through that's going to replace it? Has he got something, or is it a one-trick pony? And maybe it's not a one-trick pony. Coca-Cola has lots of different brands that it owns, but at the end of the day, Coca-Cola is Coca-Cola. As a one-trick pony, it's done very well with that one trick. It's still very much a cash cow. So maybe Gymshark is the thing to wear when you get down to the gym. Maybe that's what people are going to still be wearing and buying in their droves in 10, 20, 30 years time. But fashions are, I mean, you look at the death on the high street and kind of the brands which were up here yesterday and which have just completely fallen out of favor. It's a really fickle industry. To me, it needs a little bit more to justify that valuation. So don't get me wrong, great company, really, really good, but is it worth the 1.45 billion that it's valued at? I kind of feel that it's possible that there are better investments out there. Now, full disclosure,
I mean, it's our opinion, right? At the end of the day,
it is my opinion. And when Facebook floated, I said, don't buy the shares because they're too expensive. And that's why I'm still here, because otherwise I'd have made my fortune by now and be retired on a super yacht somewhere, Moeed. So, don't follow my advice, because I'm not qualified to give you my advice. But, I am here to share an opinion. And for me, great company, but I wouldn't be buying it at that price. But it'd be interesting to see. Again, General Athletic, they'll be looking to exit, maybe to try and float. And if they do float, what price are they going to float out? What's the multiple? Have they made money back on their investment? We'll see.
Yeah, really, really interesting company to look at. I'm actually glad that we talked about this one offline and decided to do this video, because it's a great example of a young entrepreneur, succeeding in the dream that so many others are trying to do. He's been very clever in terms of basically going after the thing that's going to make his business big, which is the brand. I mean, I think he understands it's a fickle industry and he needs to have that celebrity backing in order to endorse the brand and get people to buy it and love it. Plus, let's not take this away from him. It's a great product, actually. He's tapped into a gap in the market. There was nothing that was flattering. It apparently accentuates all the different parts of the body that young people in the gyms love to do. And I was young and I used to love doing it. So if there was Gymshark was around during my day, I for sure probably would have bought it. So it's a great business. But what I really, really like about this company is the character of the business. Steady, not slow, but steady, clever, very meticulous and measured. And what I like about what the finances said when you describe the business is that he clearly knows where he's strong and he knows where he's not so strong. And he was clever enough not to let pride dictate what he should do. He hired the right people to do the things that he can't do very well, but he's retained that role as the president, but also the chief brand officer. So he knows what he's doing and what he's doing well. I think it's a great business, great story.
It is, Moeed. You know, and some people who are looking, who are watching this video, will be thinking, you know, what are the little nuggets that I can do? What can I do to kind of emulate that? How can I be like him? And you know, I will emphasize this: do not underestimate the role of luck in what he's done.
Yeah.
You know, I'm not going to detract from anything he's done, but there has been a substantial amount of luck. The fact that he managed to contact somebody, he got in with this person, he managed to get the right introduction. You know, he'd have worked very hard for it, but there's always a degree of luck, and we can't all be lucky.
No, but I've got to say, coming from a sales background, I personally say I think there was a lot of tenacity and grit and hustle for him to get to that place where luck could come to him. So I think there's a
Absolutely.
huge amount of work that he
You
did.
can create your luck.
There is that luck that gets him over the edge, but if anyone's watching this, you better get yourself onto that square where luck will shine on you.
Absolutely.
Otherwise, there's no point. But I think great company for us to have looked at, and anyone selling to this business, we've just given you so much information there, especially about the character of the company, the way they use money, and what's going to be of value for them. So this was a great one, and you know, check out Ted's website and what he's doing, because he's a bit of a wizard with this, and you know, he can help you have a look at some of these finances and how to build up your business acumen. So I think this was a great one, and we've got another really exciting business to talk about next time. Which one are we talking about next?
Well, actually, we're not talking about an exciting business. We're talking about a pretty boring business, which isn't around anymore. And we're going to look at Thomas Cook.
Well, it's an exciting topic, though, to see why it's not around. Sorry, that's what I meant.
It is.
You're right. It's not that,
it is.
not that exciting as a business, yeah.
But we're going to be asking the question of should you check the financial accounts of your holiday provider before you book that holiday, so that you don't end up overseas and stuck like about 150,000 people did when Thomas Cook went. And why did no one see it coming? And the answer is, Moeed, we did see it coming. You just got to know where to look.
Absolutely. I cannot wait for that video. So check it out, everyone. Subscribe to the channels if you want to get notification when that video comes out. But Ted, thank you so much. This was a great topic and a great business to look at. Until the next time.